Hey everyone, welcome back to Chipstock Investor. Today is our final episode this week and this very busy earnings season. And we're going to talk about Amazon, Meta, and then we'll follow up with our final company for this week, Qualcomm. You may remember that Amazon was one of our top companies to have in our portfolio in 2024. That was in December of this last year. The thesis was simple. Amazon's profit margins are soaring, and we think that will continue throughout the rest of this year. And to close out 2023, the company certainly delivered on that goal. Year over year, revenue increased 14% to $170 billion. But really, the story here is about efficiency and it's unlocking its lead in e-commerce and cloud computing platforms. Nick, tell us a little bit more about that.
Yeah, exactly. We've had 2 decades now of Amazon's absolutely explosive growth, but relatively non-existent profit margins along the way. That has been changing, especially in the last year under new CEO Andy Jassy. It looks like they are working real hard to unlock those profit margins. So as you just said, Kasey, that's the story. Full year 2023 North America segment operating profit margin was 4.2%. Still pretty small, but up from -1% in 2022. Still lots of room for improvement. We think the introduction of ads on Prime Video, and then also Amazon finally walking away from that acquisition of iRobot this past week. Just two examples of how this is starting to play out. Also, the international segment, that's the overseas e-commerce business, basically -2% operating margin. Totally mind-boggling that a segment doing 130 billion last year is still operating at a loss, but we think Amazon will get that figured out as well. And then finally, AWS, the cloud computing segment, and the leader at over 90 billion in annual revenue, homing back in on that 30% operating profit margin in Q4, up from 24% in the fourth quarter of last year. Full year operating income margin of 27% for AWS. A bit of a reacceleration in growth again this quarter, which is promising, very promising. Lots of customer optimizations in the last year, basically customers looking to cut cloud computing costs, either by reducing their consumption or maybe downgrading to lower performing equipment in Amazon's data centers. But we think much of that hard work is now in the rearview mirror, and AWS will return to growth and more profit margin expansion in 2024.
I think all of this really comes back down to free cash flow. And that's one of the reasons that we like Amazon stock to begin with. Massive free cash flow improvements in the last 12 months. Our base case was for 50 billion in free cash flow in 2024 with upside potential. And that result is already getting close to happening. Amazon trades for about 35 times our free cash flow estimate. So that execution will definitely be key going forward if the stock is going to continue to rally. Of all the major tech giants, we continue to think Amazon provides the most value based on profit growth over the next few years.
Yeah, for sure. And you can see from these couple of charts we have that Amazon provided massive increase from essentially nil free cash flow to 30, 34, 35, 36 billion last year, depending on what kind of capital expenditures you want to subtract. Finance leases, if you subtract that out, closer to 34 billion in free cash flow. Either way, we think 50 billion is the base case for free cash flow. So what we're now eyeing is upside to that figure to support the recent stock run up. But again, yeah, we think there is so much incredible amounts of value left to be unlocked from this huge platform. So promising stuff going on for Amazon as it continues to sort of evolve into more of an e-commerce platform, sort of like how AWS is that cloud compute infrastructure platform. So we like this one still for especially the next 3 years of the big tech, AKA Magnificent Seven, whatever silly moniker you want to stick on those. That's our favorite.
Okay, let's segue into another big tech giant, Meta. And this company just announced that they're going to do their first ever dividend. The stock market seemed to really like this announcement. So, what do you think, Nick? Is this a reason to purchase the stock?
Absolutely not. I mean, it's a good thing, right? But I think this is basically Meta smoothing out its shareholder return policy. They enacted those massive amounts of share buybacks during the bear market in 2021, 2022, kind of when they were dealing with the Apple privacy changes that made it more difficult for Meta to monetize user activity on iOS devices. But sort of all that is now a backwards looking indicator that Meta was always going to be just fine. I mean, I don't know why anybody doubted it. Meta, Mark Zuckerberg certainly didn't doubt it. Look at those share repurchases. But yeah, when you have 3 billion plus active users and counting, social media is an addictive thing. It's not going to just go away overnight. Yeah, this business was always going to be just fine. And again, the dividend payment, just a way to smooth out those shareholder returns that have been coming in the form of stock repurchases up to this point. Now a dividend also going to get added into that mix.
Just for your reference, this dividend yield will be 0.4% of the current stock price. So we can give you some more details on that dividend in our video notes. You can purchase those a la carte on our Ko-fi shop, or you can join the membership and you get those show notes for free. Let's talk about free cash flow.
Yeah, let's do that. This is similar to how it's shaping up for Amazon. Free cash flow was 43 billion last year, especially impressive considering 27 billion shelled out for capital expenditures last year. That's property and equipment purchases, most of which is for that AI and accelerated computing infrastructure that Meta's been installing in their global data center base. Interestingly, maybe just a little side point here, CapEx was 31 billion in 2022, 27 billion in 2023. So, hey, this demonstrates how NVIDIA has just been inhaling, absolutely gobbling up data center market share at the expense of the, let's say, legacy non-AI data center capital expenditures. Those appear to be showing signs of bottoming out. We'll talk more about this in the coming weeks when we talk about all of the cloud computing infrastructure giants together as a whole and talk about the outlook for the semiconductor stocks that provide the equipment and the chips and all the infrastructure for that. Yeah, at any rate, 43 billion in free cash flow, that's pretty good, right, Kasey? Especially considering you have a virtual reality segment providing a pretty sizable headwind to Meta's profit margins.
Yeah, absolutely. If they could start to improve on the significant losses of Reality Labs, which is their VR business, which had an operating loss of $16 billion in 2023, I think Meta could definitely be quite efficient. But we're not counting on that portion of the business correcting just yet. A new war is brewing between Meta's VR and, of course, Apple's Vision Pro, which comes out today.
Yeah, exactly. Meta gives investors a bit more transparency on what they're spending on VR. Apple, of course, calling it spatial computing with its Vision Pro. They don't talk about how much money they're losing on Vision Pro. Maybe that will change now that they're going to start realizing some actual revenue. But at any rate, again, I think, Kasey, the point here, we held on to our Meta stock throughout the bear market. In fact, we added back in 2022. I don't think we've added since then, but we did add to this thing when it was kind of in the depths of the bear market. And much like Amazon, we see a path to 50 billion in free cash flow generation this year. And then beyond that, much, much higher. Meta really eating its own AI cooking and unlocking all sorts of efficiency gains in its operations. Currently valued at about 22 times our assumption for free cash flow in 2024. Again, 50 billion being our baseline. We think this is a reasonable price tag, and we're happy to not add more to our position here in Meta, but just continue holding what we do have already. Okay, Kasey, interesting stuff happening at Qualcomm, which we wanted to get to because this was another one of our top chip stock picks for ourselves for 2024. All these show notes, actually, we put on our Discord channel yesterday, day before we recorded and debuted this video. So again, check that out. You can access our Discord channel from a YouTube subscription here or over on our Ko-fi shop page. Also, those notes available a la carte. Yeah, a subscription isn't your speed, which we totally get. Anyways, on Qualcomm, one of our top 2024 picks. Kasey, high level numbers here were pretty good. We're pretty good for Q1 2024, which corresponds to the last 3 months of calendar year 2023, October to December.
Revenue for Q1 fiscal year 2024 was $9.9 billion, up 5% year over year, and their diluted earnings per share, $2.46, up 24% year over year. Both of those numbers exceeded their high end of guidance that they had last quarter. So Q2 for Qualcomm will be the first quarter of calendar year 2024. And we'll just talk about their outlook briefly. Revenue at the midpoint is expected to be $9.3 billion, which would be essentially flat year over year, but a 5% year over year increase on the high end of guidance. And then the non-GAAP diluted earnings per share at $2.30, which would be a 33% increase year over year.
Yeah, I think the market was a little displeased with the immediate term outlook. I think there were some hoping for higher expected revenue for the next quarter. But a few things going on here, Kasey, and we'll get to our base thesis again, which really last year revolved around free cash flow generation. And again, this year is going to ultimately revolve around the same thing happening. And you can see that happening in the operating leverage there. Just 5% revenue growth equating to almost 25% earnings per share growth. And then you cited the adjusted earnings outlook, which should jive a little bit closer with free cash flow generation. At any rate, what's going on here is, as CFO Akash Palkhiwala mentioned in his outlook commentary in the earnings call, the smartphone market has bottomed. It was a nasty late 2022 and 2023 for that market. There was that overhang of consumer electronic spending from the pandemic, but that market has bottomed. Chip inventories are healthy again. And Qualcomm, which really has positioned itself specifically towards 5G, it looks like unit shipments are going to resume growth, high single digit to low double digit percentage in 5G handset sales. And of course, average selling prices on those 5G chips, about 10-ish% higher than 4G chips. So our baseline revenue assumption, which we're using for free cash flow, we still have penciled in at roughly 8 to 12% revenue increase for fiscal 2024 for the smartphone market in particular. We have some extras in here in our show notes, which you can find on the Ko-fi shop and the Discord channel. But that's what we're looking at as far as the smartphone market. I think we're off to a good start in Qualcomm, definitely back in growth mode again this year. Let's drop down though to the automotive segment, because we think this is where things get really, really interesting and relevant to some other stocks we're investing in this year in the semiconductor space, right?
Qualcomm's automotive segment had a really huge growth that was, to me, a little unexpected. Their revenue was $598 million, which was a 31% increase from a year ago. Qualcomm is still getting a decent share of this automotive pie, right?
Yeah. In fact, Kasey, yeah, they're eating market share of this growing automotive technology segment. We've been covering this in recent months. A downturn is here for automotive and industrial chips. The question now, is this just a normal cycle? Every 2 to 3 years, this happens. You have an excess inventory of semiconductors in in the global supply chain and 3, 6, 12 months of correction. And then you get a new growth cycle. Question now is this just going to be a normal growth cycle or is it something more? And I think from a high level, Qualcomm just showed this is normal cyclicality because it's not that the automotive technology market is suddenly shrinking. Again, it's just normal inventory cyclicality. But what's really interesting here, and as you just alluded to, is the unexpected growth means they're actually taking market share again. Mobileye had a pretty lackluster outlook for Q1, the first 3 months of calendar year 2024. We don't know what NVIDIA Automotive is going to look like, but what we do know is between those two, which are heavily stilted towards advanced driver assist systems or ADAS, self-driving car technology, and then all of the IDMs out there, your microchips, your NXPs, your ON semis, your ST micros, so on and so forth, they've all been saying the first half of 2024 calendar year is going to be down because of excess inventory. Qualcomm just so happens to have a portfolio of chips and the technology in cars that it supports that indicates that, yeah, the high end of this market, ADAS, advanced driver assist systems, is down, but a lot of other tech going into cars is still very much in growth mode. And this is good stuff. We have a little bit on guidance for the automotive segment for the next quarter, right?
Yes, CFO Akash Palkawala said in the earnings call that on a sequential basis, we expect QCT IoT revenues to grow by mid to high single digit percentages, with QCT automotive revenues slightly down, consistent with the trend in the prior year. So, a bottom in IoT demand with sequential growth going forward.
Yeah. And let's provide a couple of slides here that talk about what that actually means. So that cyclicality in automotive last year, this is what it looked like. In Q1 fiscal 2023, they did 456 million in auto revenue. And then in Q2 2023, 447 million. Very small seasonal decline, which means going off of this base of 598 million in Q1, if they expect something similar this year, we're still looking at a possibly high 20% year over year growth in automotive. And if you compare that to like Mobileye, for example, that just said 50% year over year decline in the same period, that's their expectation. Again, Qualcomm slowly eating up market share of this market. Of course, their chips have a lot more to do than with just advanced driver assist and self-driving car technology. But I think we get the point here. Automotive looks like a very durable growth segment for Qualcomm.
Let's talk about Qualcomm's free cash flow story because this was one of the key parts of our investment thesis in 2024. It revolved around the company's big inventory balance because it does have some manufacturing in-house. Much of this inventory of chips is carried on balance before Qualcomm sends them for final packaging and assembly at facilities in China. And that's, again, why Qualcomm reports some two-thirds of revenue from China, since they don't realize the final device sale to consumers. That's companies like Samsung and other device partners.
Yeah, you can see from the chart put together here, the big jump in inventories from 2021 to 2022, 6.3 billion on balance. And we're still close to that. At the end of calendar year 2023, 6.25 billion in inventory. Now, part of that, we think Qualcomm is just gearing up for the next bull market. They want to have enough inventory on hand for what they see as being elevated demand in the next 2 to 3 years in the next growth cycle. But as that inventory starts to get converted into sales, we said this last year and it played out, free cash flow was going to take a big leg up. You can see this chart here showing that. And in Q1 2024, their free cash flow was again about 2.7 billion, up just 1% year over year. So at this point, that big surge in free cash flow is now just simply holding steady from the elevated jump that we had in this metric last year. We think that will continue to hold this year. Our base case is still low to mid-teens free cash flow growth for full year fiscal 2024. And why that's important for a stock like Qualcomm, this is a value stock. This is like our value bucket in our portfolio. We want to know what they do with all that free cash flow generation. And what did they do with it? I think we're pretty pleased with what they've been doing with it.
Yeah, they repurchased more stock. And in fact, they did this when the share prices were down significantly. And as a result, they doled out a higher dividend payment. The rest went back to the balance sheet to fill up that marketable securities line item, which is short-term investments.
Yeah, you can see that again in this chart we provided with purchase of stock, 784 million last quarter. Like you just said, Kasey, down year over year, but that's because they did exactly what you want to see. They bought more when the stock price was depressed, now buying a bit less when the stock price is going up. So that's fine. And then all that cash replenishing the balance sheet. We think that will continue this year. We think Qualcomm ends this year with a very, very healthy looking balance sheet and profit margins going up. So lots of R&D in the last few years for things like automotive, of course, AI, on-device AI, all the hype right now, be that those new Samsung Galaxy smartphones with new AI use cases on them. We have the Snapdragon X Elite chipset coming to laptops later this year. However you want to slice it, the real story here is all of that R&D investment starting to equate to new sales for Qualcomm, which should help boost profit margins this year again.
All of that sounds very positive, but let's talk about some risks to our investment thesis, because the smartphone market is still responsible for 70 to 80% of Qualcomm revenue. So if that recovery falters this year, what's going to happen?
Yeah, the revenue growth obviously doesn't happen. Although, again, average selling price of 5G chips, we think could still help push revenues higher, even if the smartphone market remains completely flat. But, in this scenario, lower revenue growth than the high single digit to low teens would be a negative. And of course, along with that, the upshot here is we think shares are pretty reasonably valued.
Shares trade currently for a very reasonable price of 16 times trailing 12-month free cash flow after the report. But those big increases in earnings per share planned on coming this year make the more expensive 22 times trailing 12 months earnings per share current valuation.
The big increases to earnings per share coming in the next couple of quarters, we'll see those two valuation metrics converge, we think. As it has over the course of the last year, we'll see that continue.
Okay, that's a wrap. No changes to our prior outlook for Qualcomm in 2024. So we're just going to hold steady. Potential upside in the automotive if the growth continues. We'll see. We're happy with the results.
We are. And speaking of automotive, to kick off next week, we need to cover Microchip, another one of our top stock picks for 2024. And this is one of those IDMs, integrated device manufacturers. Take a look at our semiconductor industry flowchart here. One last time, these are companies that design and manufacture chips. They factor heavily into the industrial and automotive supply chain. Microchip had some very relevant commentary for us that, like we said, Qualcomm bucked the trend, but everybody else in the midst of a downturn. We need to talk about that and why we're not too worried about Microchip yet. In fact, I guess maybe the fact that I just said that maybe a little bit of worry is creeping in is probably actually an indicator that we should be feeling optimistic. But we'll talk about that, about why that is next week.
We're still in the midst of earnings season here, so next week, we have many more earnings videos coming your way. Make sure you've hit the subscribe button and make sure you have notifications turned on. Thank you again for all of our subscribers, our viewers, our super thanks givers, and our membership members. We really appreciate all of your support. See you soon at Chipstock Investor.